Hey, everybody. Welcome to the podcast. Thank you for joining me. It's July 31st. It's the end of the month. The stock market has just closed, and a lot of red on the screen. Pretty much a bloodbath today, a vomit session, as I typically call it, because, there really weren't many places to hide today. And when you get a day like today, which we'll go through in just a minute, there's usually something working, and today there really wasn't. The Dow Jones, you can see from the chart here, it was down 312 points, down 1.85%. The S&P was down almost 40 points, down 2%. And Russell 2000 over 2%. The NASDAQ was down over 2%. Mid-caps down 2%. And so it was really a bad session overall. And again, unless you're just sitting there with tons and tons of cash, you probably lost money today. And, there hasn't been a lot of days that in the last few months where there has been these down days, especially this big. We haven't seen one like this since April. Now, the reason for this was there was more sellers than buyers, right? That's the real reason why this is happening. But everybody wants to find what caused it. What caused it? Well, Argentina defaulting certainly doesn't help. You had a 4% GDP reading yesterday, which was better than expected, and you had the Fed come out and basically taper again. And so the quantitative easing that's been there is gone. That is going to be gone at least next 6 weeks. It'll be gone. And then the focus turns to when are they going to start raising short-term interest rates, right? When are you going to get a raise on your savings accounts? And for those that buy stocks, well, they sometimes buy them on margin. And so that's going to affect the cost of their capital. So, is that why everything today decided to go down 300 points? I don't know. I think that there were some warning signs. We've been mentioning it not only in the podcast, but on the radio show. And the thing was, when you've had warning signs in the past, yeah, the market goes down for a day or two, but it's always bounced back. So those warning signs you had to take with a grain of salt, right? Because you don't want to be sitting completely out. Now, we did have, the beginning of the year, about a 6% sell-off right out of the gate. And then, of course, in the month of February, all of that came back, and then we went up even higher. Now, the Dow Jones is now officially negative on the year. So it is down for the year, joining the Russell 2000, which is down for the year. So those have lost money this year. And you can see from the chart here on the Dow Jones, it had broken out. Now it's coming back to test this. Will it bounce off of this? Because if it does, that's a great buying opportunity here. Can it bounce back from here? This is where it should bounce. Now, we do have a little bit of potential more downside. It could go to this 200-day moving average. This is where it's bounced before. If we switch over to the S&P 500, a little bit different picture. It's been in this nice little consolidation here where you can see it's just been in this channel, hasn't it? And now we're simply moving to the bottom end of the channel. We're doing it fast, but we have had episodes like this day right here. So we've had these days before, and so it's not a huge surprise, but some of the warning signs that we were seeing were small companies, small caps. This is the Russell 2000, which is small caps. They've been falling, and all year they had been underperforming the S&P 500. So, and you can see that they were, after running up last year, starting in January, a lot of volatility, but starting to move sideways, and we were wondering, is this going to start heading back down? We can't say that for sure just yet, because what I think is going to happen is if we get down to the bottom of the range here, I will more than likely be looking to buy that unless something changes, because some of our fear indicators, which I'll go over in just a minute, one of our main proprietary one is getting into the fear zone. We're in the fear zone now. We are at the point right now, as of today, where there is fear. Is there panic? No, but there is fear. After that starts to resolve itself and come back down a little bit, then we would go in and try to buy something to take advantage of this. We do have roughly around 20% cash in our aggressive strategy, which is our more tactical trading strategy. Our other strategies don't have as much cash, but of course they don't have all stocks and they don't move like the stock market every day either. The thing that was interesting about today is we've already talked about Russell down 2%, S&P down 2%, the Dow almost down 2%. But if you take a look at interest rates, Remember, interest rates yesterday had this big up day where interest rates went from basically a low of 2.46 to a high of 2.56, pretty big move in one day. You would have thought today that interest rates would have come down, right? Because people are buying basically treasuries as a safe haven. They didn't. They actually finished slightly up on the day. So if you were a bondholder today, you lost money. If you were a stockholder, you lost money. Well, maybe I had some safe haven in gold. No, down 1.15%. Well, maybe I had in oil. Now, this is a one-day-old chart. Oil was down as well again today. So everything was down. Everything across the board was down. Really, not a lot was up today. There were a few stocks up in certain very specific areas, but for the most part, they weren't up at all. Pretty much anywhere you had your money allocated, other than cash. The difference between now and 2008, when all that was going on, was treasuries were rallying. And how about in 2011 when we had a major sell-off? Gold was rallying. There was some place to move. Today there wasn't. And it is only one day, but today wasn't the first day that we've seen some weakness. We've seen some deterioration in things like, this is the 6th day in a row we've had more stocks declining than advancing, and that's something new for us. So we've had some deterioration the last few days. We just didn't see it in the S&P 500, and now, of course, it did show up in the prices. So here we are. We have a little bit further to go to get to the bottom here. Tomorrow is an options expiration day. It is a Friday. We still have global tension. So, barring some type of everybody loving the jobs report in the morning, we could have another nasty day. And that may be a time, again, for a tactical trade to go in and buy, obviously some things towards the close, because we could be getting extended to the downside. If you had a lot of cash and you needed to get invested, today was a day to buy something. Today was a day to buy something because it was down 300 points, and you got to take advantage of that. But it's not to say this couldn't keep going a little bit longer. Okay, so this is our proprietary, we call it our fear and greed indicator. This is something I came up with, probably in the late 90s, and it's been very useful. But you first have to identify what kind of market you're in, and then it's useful. But one thing that we know is when there's a lot of fear, you can buy that fear, and when there's a lot of greed, sometimes you can sell it. You do have to determine what kind of market you're in. Are you in a bull market or bear market? We're still in a bull market right now. So we still buy fear. At some point, that will change when we need to start selling greed. In other words, every time people are complacent, comfortable, you sell that. You short, you sell some stocks, whatever the case. Right now, you will notice, though, we are in these blue arrows. Blue arrows signify where kind of our threshold is for fear. And when the fear goes up into this zone up here, this is the fear zone up here. Let me color this yellow so you can see it. This is the fear zone, okay? So when we're up there, we don't really do much about it because it's almost getting too late. But what you do is once this starts coming back down, however long that takes, and it starts crossing through, again, this threshold we have, this is the buy point. And you can see these arrows signify the times where you'd have a buy point. And so even in 2007 and 8 and 9, when you had these fear spikes, you could have still bought the market back then. The key was, if it's a short-term trade, you had to put a stop on it, or you had to sell it once you had a nice profit, because if you held on to it, you could have lost money. And that's in a down market. In an up market, you just use them to buy the dips. And so we don't know if we're morphing in from a bull to a bear. I think we're in the very early stages of that, but I still think we're in a bull market. So I'm going to use this to buy the dip for our tactical strategies. And, given what the stock market's been doing, you can see this line, another day or so of that would lead me to potentially go do this either Friday towards the close or Monday, sometime when the fear kind of subsided a little bit. Okay, so that's our fear and greed indicator, which is in the fear zone, which sounds bad, but it's actually a good thing if you're looking to put capital to work. Now, here's the thing: if you're looking, let's change mindset for just a minute. Okay, let's wipe out the tactical part, because we're changing mindsets. We're saying, okay, let's assume that you watching this, and some of you aren't tactical, meaning you're not trying to trade. You're just saying, is this the tipping point where I need to go ahead and start lightening up on my longer term positions? And to me, The answer is no. And the reason why is because we're already up in that fear zone and we're getting oversold on a very short-term basis, we're going to bounce, okay? And but as I've always said, and for those of you that are new, what we need to do is monitor the bounce. And now not necessarily the points that we get back, but the quality of the rally. This was a really ugly day across the board, breadth-wise, meaning everything was down. It was probably a 90% downside volume day, if not real close to it. So we need to see, is there continuation in that? And then when there's a buy, do you get a 80, 90% upside day? In other words, almost everything makes money. That tells you it's a bottom. If it's a weak rally, then what you do is you start to lighten up on your longer-term positions at that point, because that means this thing isn't over. What happens is if you don't get the strong rally, and I'm not saying tomorrow, but in the next couple days, you don't get some type of move up that's pretty convincing, and you just get this weaker, then you're still looking at something that's probably going to head back down and roll over, and then you start getting bigger losses. So use the rallies to sell if the rallies aren't very strong. Okay, that's how you handle the longer term positions. Now, again, you have to have your plan in place. You can't be looking at this going, I don't know, I'll just flip a coin and see what happens. This is where the strategy comes into place. But don't beat yourself up when you have a one-day event. This is a one-day event. The Dow was down 300 points today. This is a one-day event. You know, you take today off of there, and we haven't had hardly anything, just a little vibration. So you're not going to get it perfect. Nobody does. But the thing is, what we're looking for is longer-term trend. Because I can tell you, again, if in the morning, if the market interprets whatever the jobs number looks like in the morning, if it interprets it as good news, we could just as easy rally and gain back what was lost. I mean, we could do that. In fact, I don't remember exactly. I think it was this day here. This was the Malaysian Airlines being shot down. So these 2 days right here were Malaysian Airlines shot down. The very next day, the market regained all of it and then and basically got back all the losses in one day. 1% back-to-back 1% days. We hadn't seen that in 60-plus days. So we could see the same thing tomorrow. We could see a rally tomorrow that gets us back, let's say 200 points. And that would cause everybody to say, okay, that was a good buying opportunity. I missed it. So don't jump to conclusions that you should be selling everything right now, running for the hills. But if you're going to be invested in stocks, there is volatility involved at times, and today was one of those days. Hey, by the way, real quick, on our website is the Investor CrossFit session, August 14th. I will tell you, we only have about 10 seats left on that. It's filled up very, very quickly. And so if you want to join that and come to that event, it's August 14th, 7 to 9 at the Houston City Club. But you do have to RSVP, and you can do so right on the website. There's a place on there to do that. You just come down, you'll click on the Read More. It takes you to the site, and you will see a form to fill out. Just ask how many people are coming, so forth. Fill that out. But we do only have about 10 seats left. So August 14th, we're going to have a lot to talk about that night. I'm actually trying to figure out how to trim some things that I'm going to talk about, because it literally could go on for hours and hours, but we're going to keep it to 2 hours that evening. All right, don't forget, if you want to follow us throughout the day, eggerscapital.com, twitter.com/Carl Eggers, and we're on Facebook, Google+. We're also on iTunes, and we have our radio show every weekend at 7 a.m. streaming on KLUP.com, or you can go to the archives on the website there at eggerscapital.com. It's called the Eggers Report. All right, guys, take care.